This conference will now be recorded.
Hello and good afternoon, everyone. I hope you are able to hear me clearly. As always, we do before we start our session, please share some confirmations in the chat box. All right, seems all good. Perfect then. To carry forward from where we left yesterday, just scratched the surface or the basics of the subject, a bit of philosophy of technical analysis, Dow theory, and we'll move forward today and bring in some bit of practicality, supports and resistance, and the classical price patterns. So let's talk about this two important aspect, which is very common. You will hear these two words, support and resistance, from many people who are in the market, who talk about the market in media. So let's understand them. What exactly is a support and a resistance? How you can figure this out on the charts yourself, and how even after figuring it out yourself, it may work or it may not work, and you should be okay with it. How you can plot them on the charts, what to look for, how to draw them on the charts, and the various other nuances. Support essentially kicks in, or we talk about supports when prices are in a downtrend or prices are coming down, right? So when prices come down or prices are in a downtrend, in terms of the underlying forces, it is supply which is greater than that of demand. So sellers or those who have it are willing to get out of it, sell it, even at a lower price, because they don't wish to hold on to it. Buyers of this asset are willing to buy, but they're willing to buy at a lower and far lower price. They want to test it out, how further down that they can buy this stock. And so the underlying forces is that of supply greater than demand, and prices come down till a certain price point comes, okay, where it may find difficulty to break down further. Why is prices not breaking down further this particular level? And if you look at the charts multiple times, you will find that prices come close to a certain level, not exactly the same, but more or less close to that zone, and it bounces back. This is termed as a support. But how is this formed? So we need to understand that at this zone, at this juncture of price, the sellers who are unwillingly, let's say, selling at a lower price because they're fearful. Sellers never want to sell at a lower price. It's the buyers who want to buy at a lower price. So after a certain degree of fall, a certain price point the stock is trading at, where the forces of supply greater than demand actually changes. And this supply greater than demand force to a lot of extent becomes supply is equal to more or less demand. Means the thought process of a seller is, come on, I cannot sell at such a lower price. No, no, no. Let the prices bounce back. I'll rather sell it at a slightly higher price. The buyers find it really attractive now. Yes, this is a really low price, a relatively low price, relatively compared to last week, last month, or last year. So the demand kicks in, the supply dries down. If both the forces play out, the supply dries down because the sellers are not willing to sell this any further. They will wait for a bounce back, and the demand kicks in because, all right, this is not a bad price, and that's why the prices do not fall. Now, when the buyers are buying in, and let's say the institutions or hedge funds or mutual funds, or let's say, let's call it smart money. Okay. So when the smart money kicks in and they're buying, that might lead to a reversal or at least a short-term halt of the fall. So this can lead to, eventually, this can lead to further fall in the future, or it can also lead to a reversal. So I write the word continuation and reversal. So it can lead to a continuation of the fall or a reversal of the fall. Whatever be the case, but a support definitely did get created at this zone. It's all over the charts. It's all over all the charts. It's all over all the charts of all financial assets. It's all over the charts of all financial assets of all time frames, 5 minutes, 1 minute, daily, weekly, monthly, quarterly. We'll figure this out, how we can find them on the charts and how to make sense of them. Exactly the opposite things, or exactly the opposite forces play out on the upside when we talk about resistance. Resistance kicks in when we are talking about a market which is going up. And what should be the primary force that will lead to such a uptrend is demand greater than supply. People are willing to quote and buy at a higher price. Sellers will be very happy with this kind of a market environment because sellers always want to sell at a higher price. And so the demand is such that whoever is selling at whatever price, it is getting bought into, and whoever is buying is not even hesitant to buy it at a higher price, and so demand greater than supply leads to an uptrend. Till a certain price level comes, wherein you will notice that it comes very close to this price level couple of times, but it fails to go beyond that. Please remember, this cannot be a fixed price level. This cannot be to the decimal point exactly same all the time. It's going to be some kind of a range, a zone. We will look into this when we look at charts. So what plays out? What is the mentality of the buyers and the sellers in this zone? The buyers who have been buying at higher and higher and higher prices, paying a premium, now feels a little exhausted. They say, come on, this is getting out of our hands. This is getting really expensive. No, I'm not gonna buy. I'm not gonna spend at this price. Let it come down. Let it come down and I'll buy at a lower price. So the demand dries off. The sellers now really enjoy this relatively high price. Prices are relatively higher than what it was a week, a month, a year back. And they really enjoy this higher price, And they would say, come on, I'm sitting on a pretty good profit. Returns are pretty good. Let's book out my position. Let's sell and book my profits. Let's transform the profits which is there on my Excel sheet to my bank account. The notional profits to real profits, and they would love to sell. So demand dries down and supply kicks in more, which leads to a certain price zone, and the market finds it difficult, the prices finds it really difficult to cross this zone. And so it will lead to a consolidation or a short-term correction. Now, this can further lead to a continuation of the previous trend, or this can also lead to a complete reversal. We will see, and we have found several examples of either of them shaping up. Yes, to some degree, we can anticipate that this time it should fall or it will not fall. Those are the price patterns that we'll be talking about today. But this is essentially what happens and how a support and resistance is formed. Now, few things we will keep in mind is more the merrier. By more the merrier, I mean the fact that, let's talk about in terms of a support, right? Let's say in terms of a support line or a support level. If you see a price coming down and it bounces back from that once, like this, is this a good support? Or rather, is this a support at all? No, because the prices have just bounced back from this level once. More the merrier means the level needs to prove itself. The level, this particular level, needs to prove itself. And if prices come back again, do you have the strength to push the prices back up and again and again? And if this happens, that you had twice, test, thrice, so multiple times when prices or this price level proves itself, it's a strong support. This implies it's a strong support. So more the merrier, minimum twice, thrice, 4, 5 times, multiple times, it's better. So this applies both, of course, for support and resistance. You should have multiple tests, retests of the same level to confirm that it's a strong support or a strong resistance. Now, these levels of supports and resistance can be horizontal, they can be angular also. What do I mean by this? What do I mean by this is, let's say you're looking at an uptrend which is behaving like this. In this case, you can have a support line which you can draw by something like this, and you'll say that, come on, this is a pretty good support because I can see it came down once, it came down twice, let's say thrice, it came down here also, let's say something like this. So this is an angular support line, it's got an angle to it. Similarly, this can also have an angular resistance resistance line. The same thing you can get in a falling market as well. In a falling market, the angular resistance will look like this, or should I draw first the two lines and then I'll fit in the prices? It will look better. Something like this. These are angular trend lines, which helps, they have a certain angle or a slant to itself, which helps you to calculate, which helps you to drop certain lines on the charts so that you can find some supports or resistance. But in terms of the strength, in terms of the validity of the breakdown, in terms of the polarity of changing their roles, what is polarity? I'll tell you now. I find that the horizontal ones are far more useful. There is a logic behind this. When we look into charts and we'll discuss, we'll get into this. That at that point it will make far more sense. So 2 points to remember here. One is more the merrier, and the other is the two angles, the two types, the horizontal ones and the angular ones. Now let's talk about polarity, and then we will straight away go to multiple charts. I will show you how you can draw them, redraw them yourself. Polarity of support and resistance. Polarity of support and resistance essentially means that they switch their roles. Support becomes resistance and vice versa. This is the concept of polarity. How does it look? Why do they behave like this? Why do they shift their roles? Let's try and understand with the help of a simple example. Let's say supply is greater than demand and we are looking into a downtrending stock. Then we notice that at a certain level, particular level, we notice that the stock had the validity of a support and it was holding well for 2-3 times. You need to understand in the market, there are primarily two types of traders who are looking to buy, who are looking to make money by buying and then selling at a higher price. And then there are others who like to sell first and buy later at a lower price and make money. The bulls and the bears. The bulls always anticipate prices to go up. The bears always anticipate that the prices will come down. Now, when a predominantly bullish trader looks into a chart like this, he really gets excited because he can see the validity of good supports. And so he thinks that the support seems to be good and I should buy when prices comes close to this support. And so in this zone, let's say the bull trader buys. with the expectation that it will go further up. It just bounces back a little bit, but then eventually, let's say, it breaks down. As it breaks down, and at the point when it's breaking down, the bears would have kept a very close watch at this chart, and would have waited, come on, let the support breaks. Once the support is broken, then the trend will continue and we will sell. Now, after this breakdown happens and the prices have fallen quite a bit from this level, what will be the typical generic behavior of the person who bought? Generally, it cannot be ascribed to each and every individual or trader. But then if you talk and if you understand the general behavior of the market, a person who goes wrong, buys a certain stock at a certain price and goes wrong and finds it 5-10% lower, that person will have a tendency to average out and he would like to buy some more. Maybe the same quantity or larger quantity, just to, there are two sides to it, just to bring down his average cost. That is from the mathematical side, that okay, I'm going to buy some more at a lower price, so my cost of holding will come down, and even a short-term bounce back will get me to my cost, to my break even. That's from the maths perspective. The other angle is the psychological perspective. That is, this person is not willing to consciously and subconsciously willing to accept that he has gone wrong. So going wrong in the stock market has two different prices to pay. Okay, I'm not going to go too detail in it because this is a psychological aspect, but we need to understand this thing, especially that you are interested in the in trading and investment. Is if we go wrong, when we go wrong, we feel bad. When we go right, we feel good. This is very natural. This has got to do with some chemical reactions in our brain. So if we go back to our school days, and if, let's say, the teacher asks a certain question and asks you to answer, or you lift up your arms and you stand up and you answer, and your answer is right, you felt good. It did not make you 1 inch taller, or it did not make you 1,000 rupees richer. It did not add anything significant to your current situation, but just the fact it makes you feel good. Okay, and then if the same man after a couple of months asked you another question on some different chapter, and then you failed to answer, and he or she said, no, you're wrong, please sit down, you need to study. Now, nothing big damage happened to you, but you felt bad. All right, so there is an aspect of feeling good and feeling bad when we go right or we go wrong. That is number one. The problem, or the double trouble with the stock market or trading and investment is, think from the perspective of the buyer who bought at the supports. When it broke down and fell further down, the double trouble for him is, of course, he feels bad because he has gone wrong. That's okay. But now, not only is he feeling bad, he's losing money. The losing money thing has far more bad feeling attached to it. So it's a double thing. One, you feel bad because you go wrong. And two, you feeling bad because not only have you gone wrong, but you're losing money. And so the people who average out, so the people, those traders who buy again at a lower price, are the people who cannot accept that they have gone wrong. And that's why they pour more fuel to the fire. And so they buy. Now the guy who went right, who sold, and who can see a neat profit coming in at the lower level, may have the tendency, or generally has the tendency, to book some profits. Booking profit for a person who has sold at a higher price will be to buy. So the bullish guy turns bullish further down to average. The bearish guy turns bullish further down to book his profits, to make money. And so the forces tends towards demand much more than that of supply. And so prices will eventually definitely bounce back. Now, a very interesting thing you will find many a times on the charts, of course not always, but many a times, is when you see the price coming back to the same level, similar level, close to that zone, how will the person who had bought, went wrong, bought further down, averaged out, bounced back to his cost or little more than his cost, what will be his thought process? Again, generally, that person, if he's sensible enough, would feel that, come on, let's get out of the stock. I went wrong. I did some daring and bought some more. Now it's got back to my cost, a little more than my cost. Let's get out of it. And so the buyer will turn into a seller. Similarly, the guy who sold at the higher price, covered at the lower price, made money by doing that, and the price comes back to the same level once again, he will again be tempted to sell at that price. And so the general tendency of the price when it comes back to the same level is supply much more than demand, and the prices tends to come down. And so you will see the switch of the roles. So you will clearly see that the demand or the support which was created here, once it got breached, changed its role and turned into a resistance. This is something that you will find on the charts quite often. I drew this example with a story to make you understand the psychology of prices, how prices think, how traders think. We cannot fit this in each and every stock and expect this to be exactly this way all the time. But it has got some merit. You will find this multiple times shaping up on your charts, and it's got some value, it's got some merit. So this is the polarity of supports and resistance. Now let's go to the charts and let's find out how we can draw them, okay, and how you can see polarity on the multiple charts. But before that, let me quickly take a look at your questions. Does volume play a role in deciding the support and resistance? Yes, and at times no also, in the sense that, let's say, when you're looking at supports, when you're looking at a level, at a zone of price where prices have come down multiple times and they have not broken further down, they have stayed stable and now showing, tendency of going up. When a support is created on the charts and you look at the volumes, and yes, if you see there has been an increase in participation, that is, there has been an increase in volumes, of course that means that more and more people have participated, which means yes, it's a strong support, which means ideally it should give us a bounce back. On the other hand, if you see that volumes have not been that great, in fact volumes have been on the lower side, then temporarily prices have not broken further down, temporarily, but because there is not much participation, eventually prices can break down. So yes, volumes do play a role, just remember, when these zones of supports or resistance are getting created, are they getting created on the back of high volumes or low volumes? Of course, higher volumes would add more weightage to it. Okay. Only closing price is taken or intraday movement, sort of. I'll explain this to you with an example that will be better for us. Why this doesn't work in real markets? Many a times I have seen the number of buyers very large and sellers are very less. And Akhilesh, the number of buyers and the number of sellers has got nothing to do with uptrends or downtrends. Let's say, for example, in any particular stock,
it's 2 o'clock.
At any point of time, let's say there are only 2 buyers who are interested to buy that stock, a stock which is coming down, okay? And these 2 buyers are, let's say, 2 mutual funds with a AUM of around 40,000 crores. In a particular scheme, they have around, let's say, 500 crores, and they want to add this stock in their portfolio. And they want to buy what, let's say, 5 crores each today. 2 buyers. On the other side, let's say there are 20 sellers, let's say individual sellers, those who have portfolio of 1 lakh, 1.5 lakh, 50,000, 2 lakhs. So now you tell me that the intensity of buying is higher on which side? Of course, the institutional side, because they have the money power. But when you count the heads, when you see how many buyers and sellers, who's standing at what price and all that, it doesn't justify. So don't go by the number of buyers and number of sellers. One simple buyer, one simple, strong, deep-pocketed buyer can hold the price, provided the people who are selling are not stronger. Okay. So with this, let's now go to the charts. I will be using TradingView for this purpose. In our next class, we'll also talk about the Spider software. Next class, when we start candlesticks, we'll dedicate the first 15-20 minutes talking about softwares. I will be sharing with you a couple of links of videos related to softwares, which I would request you to watch. But for this purpose of supports and resistance, we'll use, let's say today, we'll use TradingView. Now let's do this randomly rather than me showing you any already created chart. I'm just going to randomly scroll through my universe of stocks and stop somewhere and click on, let's say, ICICI Bank. Okay, clean daily chart, candlestick charts of ICICI Bank in front of you. Now the way to look for supports and resistance, number one, what you should not do is you should not start looking from the left to right. Do not start looking at the chart from the history, from the historical price to the current price. Don't do that. What you should do is you should start with the current price and then move your eyeballs, you shift your vision, your eyesight from right to left, that is from current to past. Number one. Number two, when you do that, you will focus upon the recent highs, I am making circles, I'm drawing them, but after a certain degree of practice, you need not do all these. I'm just doing this first time to make you understand how you should look at it. You need not mark them like this. At the initial level, you can mark them, it makes your life easier, but after that, you'll see your eyesight will get adjusted. Then you also mark the lows. Yes. So now you know that when you're looking at a particular chart, on a particular time frame, which has been the levels from where prices have moved up and which have been the levels from where prices have come down. Done? And so what you should do is you should mark them. I'm going to focus on the horizontal ones. So when you mark this high like this, you'll notice, wait a minute, if I stretch this to my left, this also, touches a previous high point. So this is an important level. Okay. Now, when you mark this, you'll notice that multiple times, little lower, little higher, this has been a very important level. So what I generally suggest, rather than using a line, you should always use something like a rectangle, where you can leave it drawn with a certain zone, because price don't touch exactly to the decimal point. So now you see that so many times, even if you can consider this also, so many times prices had come close to this level and bounced back. Can prices go out like this? What if it, should I consider the highs, lows, etc.? You don't have to consider the highs and lows, etc. exactly to the T. All that you need to do is remember this. If this is my support zone, if this 334 to 344, if let's say 335 to 345, okay, 335, 345 is a good support zone for ICICI Bank. Then if I quickly change it to the line chart, which is the closing price, most of the time it should stay above it. That is, it should not break below this. I can see it says broken slightly below this. So to curve fit it a little bit, you can do something like this. And then you find that most of the time, is this not a good support zone? Yes, indeed, it's a good support zone. Is that okay? So now going back to the candles, you can find this is a good. So like this, you can draw rectangles rather than exact horizontal lines. I always prefer to draw rectangular lines which will have a certain zone to it. Okay, like this. Starting from the right hand side of the chart, you draw and move to the left. You can give a certain particular color if you wish for supports. You can make it greenish, and you can give some other color for resistance so that visually it's easier for you to differentiate. This is all cosmetics. This I leave to you. Now you will continue to do this. So one more very important level was this one, which was a resistance. Right? And this is too far-fetched. This is way down here. So, okay, let me first draw all of them, and then I'll conclude how to look at it. Let me first draw them all. Okay, and let's say if I add a little bit of more data to this. Okay. Now you see, where are we today? 517. We are in an uptrend. When your chart is in an uptrend, there are two questions for a trader. Where is the resistance? That is, how far can it go further up? And if it comes down, where is the expected support. So we have marked the previous high, though it's just a singular high point. It's not that strong. But this is one level we can consider. It's close to the psychological 500 mark. Whenever a support or a resistance comes close to a psychological round figure, like over here we can see 500, it can be important, right? If it falls further down, then you have this zone, which is 464, 472, this part. If it falls further down, then this can act as a support. This should not be actually this. If we wish, we can make it double colored. We can keep it like this. Till this point, it was a resistance. Till this point, it was a resistance. And then after that point, it can become a support. So we can make it something like this. And so on and so forth, we have the levels on the downside. Now at 517, it makes sense to talk about 500 and maybe about 470. But then 420, 390 and 330 doesn't make sense to talk or analyze at this juncture right now. An important resistance or important support which can act as a resistance is this zone, this past zone, this one. We see that in 2019 end and early Jan 2020, ICICI Bank was within this big zone, this distribution. And this distribution had the levels okay, 1 minute. Oh, I'll figure it out. So this distribution had the higher level of around 550, around 447, 448, 550, 552. Every time it was in this zone, it faced resistance. And every time it came down to 516, 515, 519, it faced some support. Now, interestingly, look what happened here. It broke down, it bounced back, it tested that level, and then it led to a big fall. So in this juncture of around 520, in this juncture of 517, 520, ICICI Bank had proven support acted as a resistance. And so this level of 517, 520, 519 in the future can possibly act as some resistance, from where we have seen the stock has just slowed down for the last 2-3 days. It's exactly at this zone. This is it. Just by drawing simple horizontal supports and resistance, nothing fancy, and giving respect to the previous erstwhile price levels which were respected multiple times. There's another zone here which you would love to consider is this zone. Look at this particular zone. Though it's not relevant right now because prices are much higher than this, but look at this price zone. Didn't price come once, twice, thrice, 4 times, 5 times, 6 times? Multiple times prices came to this zone and just couldn't break out, which eventually happened here. But then it came down and it did a lot of drama. That's fine. We cannot expect everything to be copybook. But is this level, is this zone important? Of course it is. And when you stretch it, when we stretch this further like this, don't you see the same level confluencing with these two lows? So when it actually then tried to move out and came down, didn't it find support at 390, 380 every time? So isn't this zone important? Of course it is important. So like this, what you can do is you can create these levels of supports and resistances on your chart, and you should leave them. You should redraw them when they're broken, when they're retested, etc., etc. But that's the way to work on these charts. If you draw the angular ones, you can use a trend line. You can stretch them like this. Make sure they touch candlesticks. Make sure when you turn it into a closing price, that is a line chart, the line should be above your trend line, which you're drawing for supports and resistance. You can draw them, but as you understand that the slanted lines of supports and resistance are far more prone to breakdowns, are far more easier to break. It's the horizontal lines which gives more strength, because let's understand one thing. Let me try and explain this to you. Let me have this line back, okay? Okay. I'll try my best to explain this. Just pay a little bit of attention with me here. When I drew this line, I had more or less chosen this low and this low. This was my idea. Fine. Now, when the first low prices came down to 337, 338, it just came down for 1 or 2 days and bounced back. Then it came down here for just 1 or 2 days and bounced back. Now, if I look into it and if I ask myself, how many trades must have happened at 338, 340? How many trades must have happened at 392 or 387? Not much, right? When I look at these two, right? But when we draw horizontal ones, we see that 1 day, 2 day, 3 day, 4, 5, 6, multiple times prices comes down and doesn't break down. So when we draw with horizontal lines, we get a far more degree of participation, a far greater number of trades, a far more amount of time that prices have spent within that zone, which we may not always get in the slanted line. So I always prefer to use these horizontal ones. They are useful, they are powerful, and many a times you'll find them giving you these polarity concepts. I'll just draw in one more chart. I can see there's a suggestion to do that on Bharti Airtel. Let me take a look at your questions. How old data should we use for analysis? Very good question. How much data should we use? Let me open a new chart. A fresh chart would be easier for us to look at. I'll open Bharti Airtel because someone had mentioned Bharti Airtel. It's taking a little time. This depends on the internet and TradingView server. So there you go. We have the Bharti Airtel chart now here in front of us. Now, how much data is enough? How much data should we look at for the purpose of our analysis? How much data is needed? I don't know if anyone has written anything about this, but this is my thoughts. If you zoom in too much, then you'll have a very good look and understanding of what is happening at the present. Recent couple of months, I can see very clearly from October, November, and now mid-December, how Bharti Airtel is behaving. This is a very closer, zoomed in look. If I look into too much data, let's say now I'm looking at from the year 2018, so 18 to 19 and 19 to 2020. So now I'm looking at 2 years of data. And yes, this is a much more information about Bharti Airtel. But then I miss out on exactly what is happening at the current juncture, because what happened in October 2018 is not as important as what is happening right now, because what is happening right now is important for tomorrow. So too much data, not that great. Too little data, also not that good. It should be something wherein not only do you have a good sight of the current, but you'll have a pretty neat understanding of what had happened recently as well. When I mean recently, I have most of the time noticed that it generally gives you 9 to 10 months of data. So over here we are in mid-December and this is Feb. So around 9 to 10 months of data is good enough. Do not go by 9, 10, 8 months or 11 months. Your eyeballs will tell you that where to stop. If you're looking at this, this is too less. If you're looking at this, too much. You more or less will know, okay, yeah, this is fine. And when your eyeball says, yeah, this is fine, this is good enough. And when you look at how much data am I looking at, most of the time you will find you're looking at close to 9, 10 months, maximum a year's data. All right. So a year's data is good enough. How exactly will angular lines help us in interpreting the charts, Anjali? The same way as supports and resistance. Say, for example, in this Bharti Airtel chart, if you draw this angular line is holding the lows of October 20. This angular line is holding the lows of December 20. And if next week, next month, the prices breaks below this, then the angular line, this blue line, suggests this is support. If support breaks, then the trend is reversed. So the uptrend now becomes downtrend. This is what angular line will do for you. That's the same thing what the horizontal lines will also do for you. But what I am suggesting, what I am requesting is these angular lines, because they have a certain angle to them, of course, are very easily prone to breakdowns. They are easy to break. The horizontal ones are the ones which have much more strength, much more power. Okay. Bharti Airtel shows an inverse cup and handle pattern. So Aditya has gone a couple of steps ahead and gone into patterns, which we will talk about later today. Isn't drawing angular line very subjective, as everyone can consider different start point? Yes, that's a very good point. That's an excellent point from Hormazd. Correct me if I fail to pronounce your name right. It's quite a unique name, but he's right that it's extremely subjective in nature. If I give this daily chart of Bharti Airtel to every one of you, and I tell you take an hour's time and draw as many lines as you can, meaningful lines, then you will find that it'll be all over the place. It is very, very subjective in nature. When you look into drawing the horizontal lines, yes, they are subjective in nature indeed. But then because you are pinpointing the highs and the lows, and you're trying to find those zones where multiple times prices have come, they are subjective, but still you will find that most of you will tend to mark similar zones, because this time you're not looking at a standalone high or a standalone low. You're looking at zones. Okay, so that brings in some stability when you draw these horizontal supports and resistance. How many candle touch the line that should be a support? Minimum 2, Abhishek. It should be minimum 2. And as I mentioned, more the merrier. More than 2, it's better for it. So let's quickly try and draw some zones for Bharti Airtel, and then we will move ahead to price patterns. So Bharti Airtel daily chart. We can, okay, one more thing is these are applicable in any time frames. It can be daily, it can be weekly. So let's do Bharti Airtel from the weekly charts, because we did ICICI on the daily. So looking from left to right, there are many things that I've already noticed. One thing that I can clearly see, and this is the weekly chart. So of course the levels will be for a long-term perspective, right? This is what I tend to do. Whenever I find a good support or a resistance, first I draw, I encompass, I hold that zone. First I'll draw something like this. Then I'll tend to stretch it to my left and find if there's any further merit to this level or not. And I find not bad. Once, twice, it has been quite an important level. So on the downside, from a long-term, long-term perspective, this zone of Bharti Airtel of 400 is interesting enough. Looking further down, though it's not relevant at the current juncture, but nevertheless, it's not relevant that I know, but nevertheless, this is an important support zone. Sub 295, sub 300 levels. So 300, 400, very important zone for Bharti on the downsides. Remember one thing, we are dealing with weekly charts. So of course, the levels will be far more away. Now let's come and look at the higher side. So of course, this was the, or let's say, we can mark this. I'm going to quickly change it to the line chart and find out if I'm drawing them all okay or not. Seems to be fine. If I stretch it to the left like this. So this highs were a little higher than this, so they don't match that well. This was a little bit lower at 540, these two highs. It's called a double top. And then it went to 565, then it went to 590. So the highs tend to become a little higher. So this is not that true. This is fine. This is from the weekly perspective. This is all that we can draw. But if you look at the same chart from the daily perspective now, okay, now what you can do in TradingView is the levels, the drawing that you've drawn, you can go to the visibility and tell it that which time frame you should show it. There's no need to show them in all time frames. So I always keep those levels on that particular time frame. So the daily is clean. The important thing in daily, the way I see this is this. Very clearly, we can find this level did act as a good support. Broke down, acted as a good resistance, broke down, and now maybe it will try and find itself back up there. So this is a very important level for Bharti Airtel going forward. Now, as it broke down here, it also did create a bit of support here. It did also indeed create a bit of support here. This one from where it gave this short-term bounce back. Of course, yes. And if I stretch it to the left, it kind of meets with these highs also, which makes this level an interesting one. Now, how is Bharti Airtel dealing with this level in the current juncture? Now, that's interesting. Bharti Airtel is right at this juncture right now. This is interesting enough. So we're doing analysis of the charts, right? I'm going to definitely mark them in red as resistances. I'm going to say that the current juncture of Bharti Airtel, which is 510 to 520, seems to have some merit in terms of resistance. This used to be the support of August 20. When it broke, it just gave away. So try and understand one thing. Those who bought in these levels, of course, people must have bought. And there are many hundreds and thousands and millions of traders and investors who hold on to the levels. You'll find, of course, people who have an average costing of Bharti of 500 rupees or 520 or 530. Correct? So now the stock is back to its resistance. So a short-term resistance is 510, 520. And I think if it takes it out, then it's about 550 easily for Bharti Airtel. It's all about levels one after the other. When you're talking about technicals, it's all about levels. What if it comes down? What if this resistance works well? And if prices comes down, then how far can it fall? So let's see. Your recent short-term, small, tiny support was this one, few days back when it bounced back. Something like this. It doesn't have that much of an importance, does it? Let's keep it. You should not underestimate any level. Next, the next high comes here, highs and lows, which is this one. So it did place some degree of polarity here. Okay. The next one is this low. Now this low did have some importance here in terms of these highs and these lows. So these two levels are not that bad. And this way we can just keep the chart for Bharti. This should come down a little bit like this. We can extend this to this high, and yes, there you go. So we are looking at 495, 493, 498 kind of zones, sub which Bharti Airtel can find itself at the 464, 470 zone. So there you go. We've done our homework. We've marked the levels for Bharti Airtel on the basis of simple supports and resistances, horizontal ones. This gives clarity to us in terms of levels which we should look for when prices comes at these zones. I would request you to take up an assignment, a self-accepted assignment for the week ahead. Why don't you use the platform? Okay, I'll talk about TradingView a little bit. You use the platform, you take up charts daily, weekly, intraday, any time frame. Try and stick to opting for larger companies, larger stocks like Reliance, Tata Steel, and ICICI Bank. Because these companies, these stocks have a large, huge number of buyers and sellers, the price discovery is very, very clean. It's very nice. And so you mark them. You don't have to be right or wrong. It's for the sake of practice. Abhishek is asking about Reliance. Why don't you do it, Abhishek? Why don't you do it and share it in the group? Whoever is doing it can share it in the group. Understand one thing is that when we draw this, when we are doing this exercise, okay, and when we see Bharti Airtel dealing with 520, 510, which was a support earlier, which was a resistance earlier, etc., there is nowhere written, and there is no way we can expect that Bharti Airtel will definitely fall from here. That this is this a resistance? This is an anticipated resistance. Let me spend 2-3 minutes at this point. It is important that we discuss this point. There is some issue with the brush tool. Okay, so you need to exit the brush tool and then only they will allow you to delete. That's very strange. Anyways, see, I'll try to explain this very simple, common sense aspect about trading. What is trading? Is essentially you anticipate a price move, and when the market behaves and reacts as per your anticipation, you make money. The market can move as per your anticipation, or the market can move against your anticipation. It moves against your anticipation, you lose money. It moves as per your anticipation, yes, you will make money. Now, anticipation, your expectation, in this case, because you're doing a program, a course, I can make an assumption that you want to anticipate yourself. You want to do the hard work, you want to do the good work, you want to analyze itself, and you want to utilize your own intelligence. You want to utilize your own resource, and it's going to be your own self-built anticipation and not some advisors, not some person who comes wearing a suit on television, not someone who has written some write-up on a newspaper or a magazine. That's his anticipation. You might believe in his anticipation and bet on it, but in this case, what we are doing is we are taking authority of this anticipation ourselves. We want to decide
Bye.
Are you able to hear me? I just had an internet outage, I think, at my end. Am I audible? Okay, can you hear me? Okay, fine. So can anyone please tell me till what point was the last thing that I was saying when the outage happened? Because I did not get any notification here that you've lost your connection. So I kept on talking for some time until I realized that there's something wrong with the connection. Anyone can just put in one word till what was the last thing that I was saying? Did I talk about the anticipation all right? That was the last thing. What about the anticipation part? Didn't you hear the anticipation part about how you can create how you look into the clouds and anticipate? Okay, all right. Okay, thank you. Okay, so quite a bit. I think it was quite a bit. It was, I think, 5 minutes or more. So assignment is clear. So now what I was saying, I'll repeat once more to every one of you. Is what we are doing here on the charts is creating a certain degree of anticipation, right? And when the anticipation goes right, when the market behaves as per our anticipation, we make money. And when the market behaves against our anticipation, we lose money. That's trading. See, what we are doing over here is we have taken the decision that we are going to analyze the markets ourselves. We are going to use our own intelligence, our own resources, and we are going to do it ourselves and not decide upon someone else's decision. We're not going to go for an advisors or someone who comes on TV and tells us what to buy or sell. The fact that you're doing this program, the fact that I'm sharing my experience and knowledge with you is that you want to take your own decisions. You want to create your own anticipation. You want to trade and you want to decide that this is my anticipation from Bank Nifty. This is what I anticipate from Reliance. And based on that, I am putting my money where my anticipation lies. If it goes right, I'll feel good, I'll make money, or vice versa, right? Now, it's all about making good anticipation, good quality anticipation. I am quite consciously using the word anticipation and not using the word prediction. Prediction seems to have a certain higher degree of predictability. When someone says prediction, as if we feel it is going to go right. But when you use a slightly looser word like expectation, or let's say anticipation, you tend to stay loose, you tend to stay flexible. And it's good to stay flexible in the markets. You cannot be too rigid or the market's going to prove you wrong very soon. Now, every time I share a very simple, silly analogy, an example, to share with you the concept of anticipation, okay? And how can we relate this to charts and trading? So let's say today evening, you look out in the sky and you see dark clouds, dark gray, black clouds. And you tell me, oh, it's going to rain today evening. I said, how do you know? I said, come on, I'm, let's say, you tell me that in my life, throughout my life, I have seen these dark clouds in the sky so many times, and they generally always lead to rains. I said, okay, so you have past historical data in you, is it? You say, yes, these are all past historical data, like you showed to me yesterday in that Excel sheet of price historical data of the market. I have past historical data of clouds and so many other things. I said, oh, that's interesting. So are you sure it's going to rain? And then you say, I'm not 100% sure. You say that it generally rains, but I cannot say exactly because many a times it makes a lot of noise. The setup is beautiful, but it doesn't rain, or it doesn't rain as much as I thought it will rain, or at times it rains far more than I thought it will rain. So I tell you, okay, so there's variety. So what you anticipate and what happens may not always be true. So yeah, that's right. So these dark clouds in the sky creates a certain degree of anticipation in your mind that it's going to rain. You're not too sure when it's going to rain. You're not too sure whether it's going to rain at all or not. Neither are you sure that how much is it going to rain. Then what is the damn use of creating this anticipation? The usage of creating an anticipation based on the dark clouds is, if you have to go out somewhere, you might prepone or postpone your meeting. You might change the location of the meeting because it might rain. And you might, for example, change or alter the clothes that you're wearing, or maybe the shoes. You may not be wearing your expensive leather shoes, right? The same kind of anticipation we create on the charts. The same kind of anticipation fundamental analysts creates calculating the ratios. We all create anticipations. The same anticipation everyone in this batch has created, that, okay, if I join this course, this is the 41st batch. Okay, this is the faculty. Okay, this is certified by NAC Academy, etc., etc. So before you enrolled, didn't you create an anticipation? Don't you have right now an anticipation back of your mind somewhere stored that after this program gets over, you will be slightly better off than what you were at the beginning of the course? Isn't that your anticipation? Of course, or else why will you enroll? Right? So we live with anticipation all the time in almost every sphere of our life. And so on this chart, when you're looking at this chart of Bharti Airtel, this levels of, let's say, 510 and 520 is an anticipation of a resistance. This may lead to a fall. This may not lead to a fall. The crucial thing is, how can we transform this anticipation to an action? So if this is our anticipation, 510, 520 as a resistance, is it a strong enough anticipation that we sell and expect the prices to fall? Then we take the call that, okay, we're going to risk a little of our money, and we're going to try and make some money out of it. So you're putting your money where your anticipation lies. If it goes right, you feel good, you make money. If it goes wrong, you feel bad, and of course you lose money. But what we are going to do, and what we all of us do, trust me, not only the technical analysis or stock market, we always do all the time in our lives, is create these strong anticipations. These anticipations at times are very strong, so they become as good as certainty, and at times they are not that strong and they lose. So what we are trying to do is create these anticipation, these setups. And later on today, we'll talk about patterns, candlestick patterns. Next class, we'll talk about indicators and trading setups. These are all creating an anticipated level at which we can take an action. Let's take an action and try and make some money. Let's monetize the intelligence that we have. Okay. We're going to talk about this a little more, but right now let's talk about a bit about price patterns, the types of price patterns. Then we'll take a short break and move on to talking in detail about price patterns. Price patterns can be of two main types. Classical price patterns, the way I look into it, are classical price patterns. So let's talk about price patterns. Price patterns can be, according to my simple understanding, we can have classical price patterns, then we can have Japanese price patterns. Japanese candlestick patterns. Japanese candlestick patterns is something we are going to deal with in our next session, which is going to be our third session. We're going to talk about Japanese candlestick patterns. Then classical price patterns is what we're going to talk about today. Under the classical price patterns, we can have two different types. We can have the reversal patterns, and we can have the continuation pattern. The reversal pattern leads to a reversal of the previous trend. Reversal of trend, and continuation pattern leads to a continuation of the trend. So today, now we are going to focus on the classical price patterns, both reversal and continuation. Before we take the break, I'm going to tell you about a specialized book on this subject of patterns written by Thomas Bulkowski, the Encyclopedia of Chart Patterns. Encyclopedia of Chart Patterns is quite an exhaustive book which Thomas Bulkowski has written. See, when you hear the word encyclopedia, I don't know what comes to your mind, but what comes to my mind is a fat book. Okay, I don't think that encyclopedia can be a thin book. Okay, so this is not for the faint-hearted. This book is not for those who have never read any book except their school textbooks, even those they have not read properly. It's not for them, because this book is fat. This book is fat. This book is heavy, right? But it's a good book. It's an exhaustive book. He has covered a lot of patterns. Thankfully for you, in this NCFM curriculum, we don't have so much patterns. We have a few of them. We have the head and shoulders and the double top and double bottoms. That's it, what we have. But that's good enough to start our understanding and learning. Okay, so we're going to talk about this. The others can figure this book out. If you can please share how many pages, sir. Anjali, I don't know how many pages. I don't exactly remember. But I can tell you this, that India is an amazing jugaad country. Okay, and many a times in these classes, when I share the name of a book, many a times I've noticed by evening someone or the other has shared the PDF of the book in the group. That's okay. That's not ethical, but that's okay. But I have not counted the book of the pages of this book. In fact, I've never counted the pages of any book that I've read so far. But I can tell you it's a fat book. It's a fat book, Anjali. If you throw it to someone hard, then he'll get hurt. That fat it is. Okay. But this is for someone who wants to dive very deep into the subject and dive very deep into the concepts of patterns also. But if you're just here for the purpose of understanding the basics, then you may not go into such detailed work right now in your career. So we'll talk about reversal and continuation patterns today. We'll talk about head and shoulders. We'll talk about double tops, double bottoms, triangles, and other continuation patterns. That's what we have in the menu today. And next session we will go towards Japanese candlestick patterns the whole day. That is next Saturday. But before we go to reversal patterns and continuation patterns, I think it's time we should take a small break, like always we do, and then we can continue further for the rest of today's session. Okay, I'm going to take a couple of minutes more today. I've got a small work to take care of while I brew myself a little cup of tea. So it's 2:55, 12-13 minutes will take me to around 5:10, which is 3:05. So around 3:08, I'm going to join you. 8 minutes past 3 o'clock, I'm going to join you. So take a break, enjoy your break. You can get yourself some caffeine. 8 minutes past 3 o'clock, I'm going to start with the rest of the session. Thank you. All right. I hope everyone's back from their respective breaks. Well refreshed now. For the rest of today's session, we're going to talk about reversal and continuation patterns, the classical patterns, right? Nice book indeed, says Akhilesh. Mitesh has done the counting. He says 1040 pages for Encyclopedia of Chart Patterns by Thomas Bulkowski. What's the difference between Encyclopedia of Candle Charts from the same author? So primarily that's the difference between what classical patterns and candlestick patterns are. It's like the same author or the same chef has written two books, the Encyclopedia of Indian Cuisines and the Encyclopedia of Japanese Cuisines. So you understand the difference between these two encyclopedias. One is talking about a lot of recipes about Indian food and the other one Japanese food. So same thing here also. One is talking about patterns which are classical in nature, like I'll explain this to you right now. And in our next class, we'll look into the candlesticks. So Atul, I think by the time we're done with next Saturday, 4 o'clock, this question of yours will be self-answered, right? So classical patterns or any kind of pattern, let's understand before we go into this different types. When we use this word pattern, what exactly do I mean? What exactly are we looking for? Because we're looking at charts, there should be something related to the charts, right? Yes, of course. So what is it? What is this pattern? Is, say, for example, we see a chart which was in an uptrend, demand greater than supply, and then later on the trend reversed to a downtrend, which meant that supply was greater than demand. Now, many a times you will find that this reversal doesn't happen overnight. We need to respect one thing, that the underlying sentiment of the market was bullish. Then the underlying sentiment of the market turned bearish. Okay, so this turnaround doesn't happen overnight. There are very few rare such cases where it's like a love and hate relationship, where you like someone so much, and then all of a sudden something happened or something being said or done that all of a sudden from the next morning just don't, your feeling or your emotions just take a U-turn. So similar stuff we do tend to see on charts also, but most of the time you will find that if it has been a strong, long drawn relationship, then the turnaround or the reversal does not happen that easily. The reversal lingers, the reversal takes time, and it lingers, it drags and draws, and then after a certain amount of time it reverses. Similarly, when the demand is greater than supply, the sentiment is strong, the emotion quotient in the market is bullish. From there to the sentiment to turn sour and negative, and the emotion quotient in the market to go negative, many a times we find that prices do tend to consolidate and create a zone wherein this transformation happens. You can call this a rehab center, rehabilitation centers. It's a very common thing in the US, where someone who needs critical help on something tends to go to the rehab center, where they go through a certain process, some diet or exercises or mental processes, and it rehabs, comes out as a fresh person, as a different person, as a reversed person. So similarly, the price also enters a certain kind of a rehab center, and where this reversal process, this transformation process begins. The sentiment starts to shift, the buyers starts to dwindle out, the sellers start to become dominant. And many a times traders have found that During these zones, it takes the shape of the prices, takes the shape of a certain type, which we can call as a reversal pattern. How did this happen? How did traders figure this out? Let me take you back in history. Let's say Dow theory started this, or Dow Jones started doing this in graph sheets 100 years back. After that, let's talk about 1910, 1920, 1930s, 1940s, 1950s. All these years, hundreds and hundreds of passionate traders, learners of the subject, used to maintain price information on graph sheets, graph paper. They used to plot them, they used to plot the daily chart. Of course, intraday is very difficult to maintain in hand. So primarily, they used to maintain daily charts and weekly charts. So every day when the market closed, they used to write down the closing prices of the stocks or the index, then used to open their graph sheets and they used to draw with a pencil and draw them. And this was tedious job. Today you can, in a click of a mouse, you have the entire world in front of you, all the charts of, but it was a tedious job then. And so when they when they plotted all these and they were observing the price behavior, they found certain patterns, which is, we can say, behaviors, which were repetitive in nature. Like, for example, yesterday I told you, you studying means your exams are going on or exams are nearby. It's a repetitive nature. I can read it by your behavior. I have past historical evidences that every time you studied, it means your exams are coming up. I need to have some past historical evidence, or else how can I conclude? So based on this, they found out certain characteristics of this price, and then they started categorizing them. Then they started marking them. Okay, wait a minute. We have noticed this behavior of price in the past, and out of 10 times, 7 times prices after a rally had fallen. And now we are seeing it again for the 11th time. Is there not a chance, a probability of the same thing? That's exactly what a pattern is. That's the reversal pattern reverses a trend. On the other hand, the continuation pattern, wherein, let's say, you have an uptrend or a downtrend, either of the case, and then in a continuation pattern, it continues the trend, whatever is the center. Now we cannot call this a rehab center, because you don't come out as a new person, as a reverse person. You continue to be the Brad that you were before. So it's a continuation pattern wherein you continue to be what you were before, right? So the patterns are therefore classified in these two types. And the first one that we will do is the famous head and shoulders. The head and shoulders can be of two types: head and shoulder top and head and shoulder bottom. The head and shoulder top is a top out pattern. It suggests that the markets have topped out and will fall. Head and shoulder bottom is a bottoming out process, which suggests that the markets have bottomed out and it should go up. Now remember something, we are doing reversal patterns. Okay. So reversal of what? Reversal of the previous trend. So there need to be a previous trend, or else what will it reverse? So for head and shoulder top, the previous trend has to be an uptrend. For head and shoulder bottom, the previous trend has to be a downtrend. This is extremely important. This is extremely important to have a previous trend. Now head and shoulder top looks like this: left shoulder, head, right shoulder. This is your left shoulder. This is your head. This is your right shoulder. When you talk about the head and shoulder bottom, This is the left shoulder, this is the head, this is the right shoulder. Left shoulder, head, right shoulder. Of course, the head will be higher than the left shoulder and the right shoulder. And if you look at the shift, you can see that the head is higher than the left shoulder, but the next high falls. So it's a lower high. Markets are slowly dropping down. If you see the same behavior over here, from the left shoulder to the head, prices were coming down. But then we see this slow drift of prices now moving up from the head to the right shoulder. So now we see the shift of prices tilting on the upside. Now this tilt and this behavior of price is not good enough because they may fail. Important thing is drawing the neckline and waiting for the neckline to break. So what is this neckline? You come to these 2 points. This is the base of the head, and you join these two lines with the help of these 2 points with the help of a line like this. This is called the neckline. This is a very important line, the neckline. The same neckline you can draw here, come to this point, the base of the head, and then you draw a neckline joining the 2 points like this. This is your neckline. Till the point the neckline is not broken, till the point the neckline is not breached, the pattern is not complete. So what it means is always wait for prices to break below the neckline here and wait for prices to break above the neckline here. Okay, so always wait for the breakout, for the break. Now this break or the breakout, you need a close below. The classical rules are, let's say 3 days or 3% below. The market should stay 3 days or 3% below the neckline. But then 3 days or 3% can be too much at times to wait for. And so the bare minimum is at least wait for a proper close below the neckline or above the neckline. Always wait for a break. When you get the break, your head and shoulder pattern is complete, or I would say your head and shoulder pattern is activated. And if your head and shoulder pattern is activated, the head and shoulder top should ideally bring the price down, and the head and shoulder bottom should ideally push the prices up. This is what should ideally happen. Because it's a reversal pattern, it should lead to the reversal of the trend. Now the head and shoulder patterns also is useful to figure out the targets. You come to the highest point of the pattern, which is the head here, and you drop a perpendicular to the neckline. This vertical distance is called the height of the pattern. This vertical distance, which is called the height of the pattern, you can subtract from the breakdown point, and that point will give you a target. Are these targets met all the time? Not necessarily. Can the prices fall beyond the target? Yes, it can. Can the target may not come? Yes, it can. It may not come. But then you can work with certain kind of a level, which you can, again, the word anticipate. You can anticipate that this level should ideally come. Similarly, if you come to the head and shoulder bottom, you come to the lowest point of the head, and then you drop a straight line to the neckline, and this is the height. This height you have to add this time, and that will give you a level to work with which you can call the target. Volumes generally are exceptionally high in these breakdowns. These high volumes breakdown and high volume breakouts is a very, very common phenomenon. You would like to see, you would love to get these breakouts, the breakdowns with high volumes. Theoretically, it says that higher the volumes, it is better, but many a times you do tend to see low volume breakouts and breakdowns also. Higher the volumes, of course, tends to be a little better. Are they decent to trade? Yeah, they're not very common, neither are they very rare. Do they form in any time frames? They form in almost all time frames, but I strongly believe that the daily time frame for the charts are the best for any patterns. For any patterns that we're going to do today or the next class, the best time frame will be the daily time frame. But you do find them in the weekly or the intraday time frames. But if you want to stick to trading the patterns, I think the daily time frame is the apt one. It's the most obvious and potent one. There's one more thing I would like to share. This is not part of theory. This is not part of any book, but purely on experience. Is many a time, you will see that after the breakdown, the prices tend to throw back close to the neckline. And then a severe crack happens in the price. Very sharp crack happens in the price. In this throwback, in this what I call as a throwback, prices tend to come close to the neckline. This is where the polarity comes into play. You know what happens generally, you will notice that this is a zone of high drama. Head and shoulders is something that not only you can see, others can also find. It's not only you who's attended a course or read John J. Murphy. There are thousands of people who have read John J. Murphy and they understand head and shoulders. So that means everyone who understands head and shoulders, and if a chart has created a head and shoulder, everyone will buy and sell at the same point. Yes, and to a lot of extent no also, because everyone will use their own whims and fancies. But I have noticed time and again that many a times after the initial break, the first theoretical break, if it doesn't fall or if it doesn't rise, and then there is a throwback towards the neckline, and after that if the fall or after that if the rise comes, that is a severe one, that is a high dramatic one. So keep a close eye, or what you can do is when these breakdowns come, you can create a position which is half the quantity and wait for the throwback, because the throwback can lead to a very good potent trade. Okay. We will see some examples once we are done with the theoretical parts. How can we how to check volumes along with it? When you have the charts, make sure you have volumes plotted at the bottom, and when you have the volumes plotted at the bottom, they will help you to understand that okay, this breakdown is happening with high volumes or low volumes. So that's how you do that, like this. Okay, now let's go to the next pattern. Let's talk about the pattern which you'll find extremely common in Indian market charts. I find it quite often all over the place, is the double top. Okay, the double top and the double bottom. The double top and the double bottom is again a reversal pattern, and you will find them, the double top is a topping out pattern, so it will lead to a fall. The double bottom is a bottoming out pattern, so it will lead to a rise in prices. Double top will always come in an uptrend. Double bottom should always shape up after a downtrend. It creates a resistance where the prices tests itself twice, something like this. It goes up, tests a level once, comes down and comes back too close to that zone twice, and it creates some kind of a double top once and twice. Similarly, double bottom, which comes after a downtrend, will create certain kind of a support where it comes and tests once, bounces back, and then finds itself back again in that zone and bounces back once and twice. That's a double bottom. If this happens thrice, 4 times, 5, if it happens thrice, it's called triple top and triple bottom. If it happens 4, 5, 6 times, I don't know what to call them. It generally takes some kind of a consolidation. The double top and double bottom is a very common thing. How to initiate a trade, how to act upon them. Similarly, over here also, you will look at the previous base point. This is the similar base point that we found in the neckline, and you can draw a line as per this level. And you have to now wait for the prices to break this level. It needs to be broken. Can it give me a throwback? Yes, it can give you a throwback, not always, and then it can fall, or it can fall from here also, or it can just reverse itself. This is a failure. Everything cannot go right all the time, right? You should be open to everything that the market throws at you. You'll notice that this pattern typically takes the shape of a M. Over here, the height of the pattern also plays a role. You calculate the vertical height of this distance. Let's call it height. And this much distance you subtract from the breakdown point, and this height acts as your target. Of course, in this case also, volumes tends to be higher, like in most of the cases. Volumes will tend to be higher in the double bottom also. Now for double bottom, this is the base, and this is, we don't call it a neckline, but you can say the breakout line or the resistance line. Ideally, price should break away from this. It can run away like this. It can give you a throwback and then run away like this, or it can run away. It will try to run away, but then it comes and gives you a failure. You should be open to all. Just like when you see dark clouds in the sky, you may or may not get rainfall, so please be open, or else you'll be disappointed. This guy tends to take the shape of a W. And this guy also will walk as per your height of the pattern. You can drop the vertical distance, call it the height, add it this time from the breakout point, and this is the height, and this will act as your target. Remember this, these patterns don't go right all the time. Should always keep this in mind. There will be failures. Volumes also tends to be higher. This is a very common pattern. We'll find them once. Let me just cover the theoretical part, and then we can go to the charts and figure them out on the charts itself. Head and shoulder top, head and shoulder bottom, double top, double bottom. These are the main reversal patterns which are there in your curriculum. There are more, as I said, once you understand the concept, that the trend is about to get reversed. The uptrend is going to turn down. The downtrend is going to turn up. In this transformation, in this shift, there can be a zone of transformation. There can be a time, a price and time zone where prices will take its own sweet time and go through this transformation. Like a typical caterpillar becomes a butterfly. Similarly, you can say something like that. And these create reversal patterns. We have done only 2 types of 4 variations, double top, double bottom, head and shoulder top, and shoulder bottom. So there are 4 patterns, but there are quite a few more. But these 2, especially the double top and double bottom, is the one you'll find fascinating, especially in the examples we'll look into later. Okay. If you trade these, your stop losses should ideally be the case where your pattern goes negative. Okay. So once, let's say in the neckline, once prices enters the neckline, after breaking the neckline, if prices go inside the neckline, you should come out of it because you know it's wrong. Okay, it's gone wrong. Now quickly talk about continuation patterns. Okay, triangles. Triangles are your continuation patterns. The first category of continuation patterns are the triangles. Triangles can be of primarily 4 different types. Now remember, we are talking about those patterns which will not reverse the trend, but which will continue the trend. Symmetrical triangle. Ascending triangle. Descending triangle. Broadening triangle. Symmetrical triangle takes the shape like this. This can come after an uptrend, this can come after a downtrend, but it needs 4 points to create this. The price behavior ideally looks like this: 1 point, 2 point, 3 point, and the 4th point. So if you look at touches, it creates 2 points on the top and 2 points on the bottom, and then you have this triangular formation. The highs are dropping, which is not a good sign. The lows are rising, which is a bullish sign. So you notice that prices are getting squeezed out. The prices are getting narrower and narrower into a zone. And eventually these prices break out. It just snaps out. If the trend was up before the pattern, ideally the trend should continue because we're talking about continuation patterns. It's also called the coil. It's also called the coil. It's called the coil because if you look at a spring, if you squeeze the spring between your 2 fingers, and if you let it go, the spring just snaps out. Exactly the same thing happens over here. Because the highs are getting lower, getting bearish. The lows are getting higher, it's getting bullish. So it's getting squeezed out. Prices just can't breathe anymore and it just needs to break out. And generally these breakouts are one way, very sharp breakout. I think the small cap or the mid cap index gave a beautiful symmetrical triangle breakout recently. This is a typical symmetrical triangle breakout. Works good as a good continuation pattern. Remember one thing, it needs to have a previous trend. It is very, very important. If the market is trendless and then you see a pattern like this, and then you say, wow, I got a symmetrical triangle, it's going to break out. Which way is it going to break out, up or down? Look at the previous trend. There is no trend. So please remember, there needs to be a proper trend before, right? Ascending triangle. Ascending triangle looks like this. And within this, the price behavior, let's say an uptrend, also will have 4 points. 1, 2, 3, 4. Twice at the top, twice at the bottom. At the top here and here, it's at the same level. So resistance is same, but the supports are getting higher. You see the lows are getting higher. Ideally, it should give you a breakout like this. This is where a double top fails, or a double top even never gets triggered. If you look at the price behavior, doesn't it look like a double top? Yes, but the double top will only get triggered below which price point? Below this price point. It never comes down to that price point. The double top never shapes up, just breaks out on the upside. The ascending triangle works pretty good as a continuation pattern as well. This can shape up in an uptrend. This can shape up in a downtrend too. Descending triangle. Descending triangle looks like this, wherein the price behavior, let's say an uptrend, gets inside the pattern once, twice, thrice, and 4 times. So you have 2 highs here, and you have the 2 lows here. Your 2 lows are at the fixed level, so the support is fixed. Your resistance is dropping, which is a slightly bearish in nature. Ideally, it should continue the trend, and so you should have a breakout in the line of the previous trend. They can shape up in an uptrend as well as a downtrend, your descending triangle. One common thing between all of them, amongst all continuation patterns, volumes very, very low within the patterns. Very dry within the pattern. This is important. This is not only related to the triangles, it is related to all types of continuation patterns. Okay. Finally, let's talk about the broadening triangle. Broadening triangle is something that one should stay away from. A broadening triangle looks like this. It is a structure which creates a lot of confusion. Prices goes up and makes a high, comes down, makes a second point of. The third point of contact is higher. The market has broken the previous high and gone higher. So it's turned bullish. The moment it turns bullish, prices starts to come down and breaks the previous low. The previous low is broken, and so everyone turned bearish. Again, when it turns bearish, again it starts to pick up. And so it takes the shape of a broadening triangle. Stay away. This cannot be traded. It's an indication that the market is not sure what it wants to do. The symmetrical ascending and descending triangle are tradable. The failures do happen. How can you safeguard yourself? The moment it breaks out, it should continue the trend. The moment it gets inside the pattern again, after breaking out, it has come out of the pattern, and then later on it slipped inside the pattern. It starts to do the opposite. Then you should come out of the trade. It is not playing out the way it should. Triangles are also very common. You'll find triangles all over the charts in all the different time frames. But the best of the time frames, as I said some time back, is always the daily chart. Now, let's talk about the wedge. Very interesting pattern. Very, very interesting indeed. I'm going to keep it in one page so that you get the entire picture easily. Let me break it down. Break my page into 4 parts. Let's talk about the wedge. Very interesting pattern. Okay. The wedge has 2 sides to it. It's like a two-faced guy, but very, very interesting. It can act as a continuation pattern. It can act as a reversal pattern also. So it's a little schizophrenic. But then not really a crazy schizophrenic. It does give proper signals. A wedge looks like this. This is a falling wedge. This is a rising wedge. Okay. This is a falling wedge. This is a rising wedge. Okay. Now let's try and understand the price behavior. Let's say an uptrend. 0.1, 0.2, 0.3, 0.4. What is the trend? It's a rising market. Rising price. Yeah, it's a rising price. What is the wedge? It's a rising wedge. So I'm sorry, this is a falling wedge. I'm very sorry. It's a falling wedge. So the angle of the wedge is falling. The angle of the price is rising. So they're opposite. When this happens, they will continue. What is the difference between the wedge and a symmetrical triangle? If you look at very clearly, very closely, a symmetrical triangle is made up of 2 lines like this. One is sloping down, one is sloping up. One is sloping down, one is sloping up. But when you look at a wedge, both of them either slope down or both of them slope up. This is the main difference between a symmetrical triangle and a wedge. Okay? So in a rising market, if you have a falling wedge, it continues. In a falling market, if you have a rising wedge, that also continues. In this case, it's a falling market, falling price. But if you look at the wedge, it's a rising wedge. So when the angle of the wedge and the angle of the price are opposite, it continues. And so if the angle of the wedge and the trend of the price is the same, then it reverses. What is happening here? Falling price. Yes, it is a falling price. It's in a downtrend. And when you look at the wedge, It's a falling wedge. So falling price, falling wedge, the angle of the price and angle of the wedge is the same. This will lead to reversal, very, very sharp reversals. When the angle of the price, that is the trend of the price, is positive and the angle of the wedge is also positive, this can lead to a reversal. This is something that you will find nowadays in many stocks. You will find this behavior shaping up in the rising market, the rising wedge. When it goes right, when the reversal side goes right, it leads to severe reversals. It leads to severe reversals. The continuation side of the wedge is very common, and the continuation side of the wedge generally never fades. The wedge is primarily a continuation pattern. Let's understand this. Wedge is primarily the left hand side. It is continuation in nature, but kabhi kabhar it tends to create this shape. I have seen few of them work beautifully. Of course, there are failures because it breaks down and it does not break too much, then it picks up again. So all that drama, of course, happens in the market. That's okay, but it gives you a good understanding of what's happening in the market. The wedges. After the wedge, the last set is the flag and the pennant. Flag and the pennant are the good boys. There's not much problems with the flag and the pennant. Flag and the pennant. The flag is a parallelogram which is either sloping a little down like this or sloping a little up like this. Very, very similar to the behavior of the wedge. But in wedge, what happens? In wedge, what happens? The two lines meet somewhere in the future. In flag, they don't meet. That's the main difference. So in flag, you have two lines which are parallel to each other. This become a little too angular. Sloping little down or sloping little up. The price behavior, when it's down, is on the upside. It goes into a flag behavior and it picks up like this. It's in a downtrend, goes inside a flag and it comes down. Very, very similar to what you would have seen in the wedge continuation side. The only difference between the wedge and the flag in this case is that the wedge is angular and the two lines of the wedge meets. The two lines of the wedge meets, and over here the two lines of the pattern do not meet. They are parallel to each other. It's a flag. Flags fly half mast, which means that it's been observed that whatever was the distance traveled before the flag will generally be the distance after the flag, which tends to give you a sense of target. Whatever was the distance before the flag should ideally be the distance after the flag. The flag. Volumes within the flag will be very low. I have mentioned this. In all continuation patterns, volumes are going to be very, very low. Pennants are nothing but symmetrical triangles. They are exactly same like symmetrical triangles. The only difference between a pennant and a symmetrical triangle is pennants are short term in nature, just couple of days, 2-3 days, and it's over. Symmetrical triangle can take few days. So pennants are nothing but short-term symmetrical triangles. They are formed like 5 to 10 days and they're over. Not even 10 days, like 3-5 days and they're over. Symmetrical triangles might take a much more time. Okay. Flags and pennants, both of them are good continuation patterns. They generally do not reverse. They generally do not reverse. They are pretty decent continuation patterns. They tend to continue. It is the wedge which has this ability to act as a reversal as well as a continuation. Let me try and quickly show you some examples. When it comes to wedge, one example that I keep on going back to is that of the Nifty, right at the top of 2007. There are many examples. As we move on with our program, as we continue with our program, as we share more examples on the charts, we will be in a position, we will be able to share many such examples. In fact, I'll try and work and create a repository of these examples. So this is the 2007 top. The rising market, rising wedge. This is not exactly a falling wedge. You can't call this exactly a falling wedge, but to a lot of extent it is. Falling wedge in a falling market reverses the trend. Like this, there are many examples. In fact, as I was telling you, at the current juncture, there you'll find few stocks which are creating very, very similar movement. You will not be surprised to see what the Bank Nifty is trying to do. The Bank Nifty on the daily chart is actually not exactly a wedge, but you get the picture. It is kind of getting squeezed out at the top. It's getting squeezed out definitely at the top, right? So this is the same thing on the weekly charts. Like this, you'll find many patterns, many patterns in the sense that many examples of these patterns. Let me, like I did last time, let me randomly stop at any place and let's say HCL Tech. I click on HCL Tech and you would find that over here the stock had kind of made once and twice double bottom. In this case, the double bottom, the double top did not get triggered. Once, twice, never got triggered. In fact, this was a breakout. This was some kind of a, let me check whether it was an ascending triangle or not. Kind of, not a very good angle, but yes, you get the picture. It's kind of an ascending triangle breakout. This is a wedge breakout. Rising market, falling wedge, continuation. Rising market, falling wedge, continuation. Right? Let's say we took at Tata Motors. Tata Motors down here, you can clearly see once, twice, same level, similar level, bouncing back. Once, twice, did not fall as much as you would have anticipated. Maybe you got the height, maybe we need to figure it out, but you got the picture. It's creating a left shoulder, it has created a head, and now it is creating a right shoulder. Is this a head and shoulder? We will see. This is the neckline. In this case, this gave a breakout, like a flaggish kind of a breakout. This was a clean short-term wedge. You can call it a descending triangle also. But you would have noticed that I am kind of drawing them very easily, or I can find them quite easily because I've spent a lot of time with the charts for the last 16 years. You'll also get better at it with a little bit of practice. I would suggest this. With the assignment of drawing the horizontal support and resistance that we discussed before, why don't you also take up few charts? Only stick to the daily charts. Only stick to the daily charts. Don't go to lower time frames or higher time frames. Stick to the daily chart. Pick up stocks charts like Tata Steel, Maruti, Infosys, Reliance, Tata Motors, right? Nifty 50 stocks, and open the daily chart and try and figure out some patterns. Don't try too hard. If you think this is head and shoulder market, post it in the group. Let's take a look. If you see double tops and double bottoms for you will be easier to find. Double tops and double bottoms are very common, and for you it will be easier to find. The tricky ones will be the head and shoulders. The wedge also will not be very difficult for you to find. You will find wedges, quite a few of them on your charts. You'll find these wedges shaping up. You might also land up finding some good pattern failures. That's also very important. If you find a good pattern failure, you should mark it and you should share it as well. So look at this example over here. This is not a very good double top. You know why? Because the uptrend is not very strong. This is a good double bottom. This is after a big fall. So you'll find a lot of examples. Why don't you just spend some time over the week and share it in our group, mark these, take a screenshot, and with a little bit of practice, you're gonna definitely get better at it. There's no doubt about it. There are more patterns, but I would suggest whatever is there in our curriculum so far, whatever I've covered, is good enough.
It's 4 o'clock.
Thank you, Siri. It's good enough to start the work. And with time, we are gonna get better with it. With a little bit of practice and experience as you track the markets, of course, you're gonna get better. In a rising wedge, there are options for both continuous as well as reversal. So how do we differentiate there? I think, Anjali, you completely missed out when I was explaining the wedge. You would have noticed this. I had written very clearly that the rising wedge needs to be checked with the angle of the price. So please note here, the rising wedge is coming in a falling market environment or a rising market environment. And as I was saying, if the rising wedge comes in the rising market, it creates to reversal. If the rising wedge comes in a falling market, it leads to continuation. That is the key differentiating factor. That is the key differentiating factor. Okay. If time permits, can you explain cup and handle? Cup and handle is a very similar breakout pattern. I will not take it up because it's not there in the curriculum. Deep, why don't, who's asked this? I think Deep has. Why don't you take a look? See, I hope I have explained the concept of patterns. There are cup and handles. There are many others also. Why don't you give it a try yourself? Just do a cup and handle check, find some examples over the net. And I'm quite sure if you've understood today's class, the psyche about prices, how they create these patterns and how they behave, you'll understand cup and handle, and you can understand many patterns in Thomas Bulkowski's book. So give it a try yourself. If you don't understand, bounce it off with me. I'll definitely clear out your doubts. All right. How do we deal with false breakouts? You just have to deal with it. It's gone wrong. You need to cut it out and accept that it has gone wrong. That's it. Can you please explain the logic for this? If price is falling and a falling wedge is formed, isn't it supporting the down move? No, it's not necessarily supporting the down move, because if you draw down, if you visualize closely what is happening, it is coming down, but the rate at which it is falling one after the other is actually slowing down. It's slowing down the rate of fall. It is slowing down the rate of fall. This is the main reason why it leads to the reversal. Okay. All right, so I'll share this with you, this PDF, and we're going to meet again next Saturday, 1:30, wherein we're going to talk about the whole day about Japanese candlestick patterns. Okay, spend some time. If I've missed out answering any of your questions, put it on the WhatsApp. I'll take care of it. Don't worry. Do share some screenshots of the homework, of the assignments that you do. It will be easier for me to understand and gauge how well you're understanding. Do not hurry. Do not haste. Take it step by step. But do spend some time on the charts. All right. Okay, then I'm going to sign off now. I'm going to catch up with you again next Saturday, 1:30. If there's any question left unanswered, please post it on the WhatsApp. I'll take care of it. All right. Thank you. Enjoy the rest of your Sunday and your weekend. I'll catch up with you next Saturday, 1:30. Thank you.